Let's bring in Kevin Gordan now, Charles Schwab and Max Kettner of HSBC Global Research. Good to have you both with us. Kevin, you've heard Tom state his case for stocks in the near term. Let's stay near term. What do you think?
Yeah, no, I largely agree with it. I think that if you're approaching it from, a PE versus earnings standpoint, how much is left to be squeezed out of the valuation upside? Probably, not as much, given we look pretty stretched, whether you're looking sector by sector or whether you're looking, at the aggregate market. I think that, in terms of the Fed reaction, I think it's a little bit, I know there's a lot of obsession around the cut itself and what it means, but I think you have to sort of take a step back and think about what the Fed's looking at, being economic data, and ultimately that's what the market looks like. So, as we sort of continue to go through this process of churn where you're still waiting for more rate-sensitive parts of the economy to maybe respond to what the Fed is now doing in terms of cutting, and hopefully find some sort of revival in the next 6 months versus what's now going on in services and labor. If we continue to see softening trends, the latter, if that happens, probably won't be the most bullish case for the market.
Max, what's your view?
Yeah, look, I think I'm still pretty bullish even in the near term on stocks in particular and on US stocks in particular. We've been buying the dip in the last couple of months, and when we continue to do so, I think actually there is probably a little bit too much obsession around the US elections. I do think one thing that is a bit underappreciated is the earnings trajectory in the very near term. We look at the Q3 reporting season, for example, at the S&P. In fact, we see earnings expectations from consensus almost flat quarter over quarter on an aggregate basis. It's tech up, it's utilities up, which is the sort of normal Q3 seasonality. But other than that, every other sector is either flat to slightly down. So I do see the risk, the upside risk, that clearly, people are perhaps focusing a little bit too much on the noise and not really taking into account still really solid fundamentals. I would agree with what you guys have been talking about before. There is an awful lot of talk still about recession and around a severe slowdown. In fact, when we look, for example, at our colleagues, they run a quarterly emerging market sentiment survey, which just came out today, where basically expectations around a recession or a major drawdown in DM and developed market activity is by far the biggest risk that investors see. That more than tripled over the last quarter, those kind of recession fears. And funnily enough, when we look at our sentiment and positioning indicators, even though we're on an all-time high, even though high yield spreads are sub 300, even though investment grade is sub 90, you're still seeing our sentiment and positioning indicators closer to a buy signal rather than a sell signal. That, to me, I don't really want to be cautious at that point.
What about, Tom, this idea, as Max said, there's too much obsession about the election? I think people would say, I don't think so. What do you think?
I think elections are very emotional issues, and I think it does cloud people's willingness to take a risk or how they react to information. So I kind of agree with the idea that the stock market's going to be fine regardless of who wins. But between now and then, it's very difficult for an institutional manager to make a big bet one way or another because of the election, and it could even be a disputed election.
I mean, you have diametrically different tax policy being discussed by the candidates. So how is it a win either way?
Well, I think one thing that investors have to be mindful of is unless there's a Republican sweep or a Democratic sweep, then these are just policy platforms that will have some challenge to actually get put into law. But I think more importantly, things like AI are really shifting like the axis of where all the future growth is coming from, which is the U.S., and they're not really going to be hurt by whoever is president.
Deb, you think that the market's reasonably valued here? We've had this conversation about the multiple that the market currently trades and where earnings expectations are for next year, expected to grow like 15%.
Yeah.
You think that's too optimistic?
I mean, well, for valuation, in my opinion, it's always in the eye of the beholder, and it depends on which metric you're looking at. We use valuation more as a sentiment metric or an indicator of sentiment. So when you're in a stretched environment, that just tells me that people are willing to pay high prices for stocks.
Are we stretched? Are we in a stretched environment?
No, yeah, I think we're stretched, especially now, given the fixed income environment, how much it's shifted over the past, few years. You still have income and fixed income, even with the rolling over in yields, and so there is still an attractive nature to bonds relative to stocks. To Tom's point earlier, I don't think you can make this outright direct comparison. I think there's an and, not an or, when it comes to stocks and bonds. But for earnings itself, The somewhat, maybe counterintuitive aspect about earnings growth is that as you get further into the earnings cycle and growth accelerates well into double-digit percentage territory, that's historically consistent with more tepid gains for the market. Not an outright decline, not negative gains annualized, but the best zone is when you're emerging from an earnings recession and the market is sort of sniffing that out and catching on to that force. Now you've kind of priced it in already, which is what happened at the end of 2023 into the beginning of this year. And now you're getting to the point where, it looks like the market has already looked ahead to what has been and what will probably continue to be a relatively healthy earnings cycle.
Right, Max. I mean, is to that point, which is a good one and made by others too, isn't a lot already priced in?
Yeah, but in fairness, we could have argued this 6 months ago, 12 months ago, 18 months ago. I think to the point in terms of the earnings recovery, one thing is very clear. When we look at the second quarter, we've actually just regained the levels where we were in 2022 in terms of net income of the S&P 500 outside of the Magnificent Seven. So those 493 stocks, the broader market, that's literally just reclaimed the level where we were at the beginning of 2022 in terms of net income. What that tells you is that that is still very much lagging versus overall growth. And as growth still, probably still chugs along pretty nicely. I mean, with an outcast saying 3%, a lot of the high frequency data like the Dallas Fed's weekly activity index still suggesting around 3% GDP growth for Q3. All of that should actually say that we are right now getting out of the worst and perhaps the bottom of the earnings recession for the broader market, for those 493, and that there is still quite a bit of a catch-up to play for the broader market, really. And that also should be helping a bit of also the broadening story overall.